How come it feels like it's been a month and a half, Chris?
I mean, just being away from me, Anthony, it just,
Yes.
it's hard to be away from me. How are you, Anthony? Tell
I
me
I
some good
I,
news on a Tuesday morning.
I am I'm doing well. I'm excited. I've got a financial dad joke.
Okay, tell me your financial dad joke.
How does Santa's CFO value his sleigh?
How does Santa's CFO value his sleigh? I don't know.
At net present value. It's terrible, but it's on
It's
topic. It's
I
terrible.
don't
I know. What's your
yeah.
dad? Come on, top me on that one. That one's not hard to top.
Where do pirates get their hooks, Anthony?
Oh, this should be easy. From the something store, from the not what's a pun for hook? What's another word for hook? From the I so
From the
wanted to get this.
secondhand store, Anthony.
Oh,
From the
secondhand store.
secondhand
Very
store.
good. Okay, you got it. Very good.
Anthony, what if your profitable quarter is actually the first warning sign of bankruptcy? A word we don't like to say on Data Fender. KOTN, a sustainable basics brand, showed 30% margins in 2018 while supply chain payment terms crushed liquidity. Profit margins celebrated what cash flow positions condemned. Today on How to Founder, Anthony, we're going to be talking about the profitability paradox. When showing profit actually signals you're racing towards a cash crisis that could kill your business. I am your host, Chris Franks. With me today, Mr. Anthony Franco. How are you, Anthony? You're looking sassy.
I'm doing well. I like I was saying before we jumped on, I'm in builder mode. So I am coding 18 hours a day every day. My wife and kids, they seem like good people, but I haven't seen them in so long that
Yeah, I was gonna say let's just make sure that we're keeping up our personal hygiene, Anthony. Come out of the basement, take a shower every once in a while.
Shauna said that our kids spoiled, and I'm like, no, they smell fine.
Thank God, joining us today is Abir Syed, the e-commerce CFO who gets marketing. He's helped DTC brands like Ollie and Man-Made turn financial insights into Go strategy as co-founder of Up Counting. Abir, welcome. Apologies for the dad jokes. Thank you for joining us. Do you have any dad jokes? You got any go-tos you like?
Man, not as good as yours, but thank you for having me. I'll give you one. I don't know. This one would land with like real accounting nerds, but I'll say
good.
Oh yeah.
So I had a really good joke about amortization, but you wouldn't appreciate it.
It's good. It's good. It's a little nerdy, but
it's a little deep. It's good ball knowledge.
Yeah. All right. So let's just get into this thing. Why do founders, like, we celebrate these quarterly profits, but we ignore cash positions? What's determining, like, what is the thing that we should be paying attention to, Abir?
Honestly, it really comes down to a founder understanding what levers matter the most for their business or their industry. So if you're in like the SaaS world, then you're going to be looking at cash from a particular lens that focuses more on, for example, your burn rate. But if you're, say, in the e-com world where, inventory cycles are a big thing, then you're not really looking necessarily at burn rate unless you happen to be running, you've raised a lot of money and you're running that way, but you're looking at the cash cycle, so your cash conversion cycle, because you need to know how much of a gap you have to bridge through financing and stuff like that. I think a lot of times founders don't, understandably so, but they don't necessarily know what like the key numbers are for their business, for their industry. And so they're not necessarily keeping their eye on the right ball, but it'll always depend on how you're planning on running your business to determine which metrics are the most important ones to monitor. There's a lot of different ways to slice and dice financial data, but for most businesses, as long as you're paying attention to like a good 5-ish metrics on a month-by-month basis, you'll at least see any like the big disasters coming ahead of time.
Well, Anthony likes to keep his eye on his ball quite a bit. He keeps that eye His one eye. His one eye. All right. So here's my sort of provocative question, which is I've told entrepreneurs this. There's only a couple of metrics that matter, which is lifetime value, cost to acquire,
Mhm.
and runway. Like this is like of everything else, like you have to have the cash in the bank,
Well,
cost to acquire customers, lifetime value. Is that
change runway to cash flow, and I'll agree with you.
yeah, well, I mean, yeah, cash,
Same different. Like
runway,
cash flows up
right.
incorporates runway for sure.
Yeah. And so what do you, is that heretical? Is that correct? I mean, obviously that's kind of the very high end, but is that a good place for us to start as founders?
I think you're pretty damn close to the money. I would probably tweak it slightly because you could argue that LTV and CAC are kind of just two metrics that can summarize into lifetime profit. So how much profit are you getting from a customer? So if I were to pick my three, I'd be pretty close. It could be your cash flow. So anything from a cash perspective, your lifetime profit, which is the difference between your LTV and your CAC, and then the your top line. And the reason I include top line is I know that a lot of times finance people in particular tend to be like, don't worry about your revenue. It's all about profits and all that kind of stuff. But like the truth is that like you could have the greatest, LTGP to CAC ratio. You could have really high lifetime profit. But if you can only acquire 7 customers, like great. That's not really something to get excited about. So, overall volume still needs some sort of metric. Cash flow is just kind of more the reality of things. And your LTV to CAC is telling you what your growth potential is. So to me, that covers like the 3 main things that like an investor might care about.
So let's dive into that, and I'll make you answer this question, Anthony. Is VCs and investors often have a different set of math than we as business operators have. What's been your experience with when you're talking to potential investors, when you're talking to VCs versus a running a repeatable and sustainable business?
Well, and there's another lens to look at that too. It's not just VCs; it's also acquirers. So I'm gonna give you both. VCs. It really depends on if you actually have revenue. If you actually have revenue, the numbers now start to matter. If you're pre-revenue, you might be able to get a better value. This is so counterintuitive. You might be able to get a better valuation if you don't have revenue, but you have traction, than if you do have revenue and you have something that they can actually apply math to for evaluation.
It's such a weird thing, right? It's strange,
super weird. And
that the moment that you actually have.
Yeah. It's also counterintuitive for acquirers. Let me give you a direct example. So when I sold Effective, we were 20 some odd percent, 22% profitable, which is pretty good for a services business. But would I have taken $1 million, a $2 million project at 10%? 100% I would have. Right,
it's cash.
But one of those opportunities came our way after we were acquired, and our acquirer said no. Like they weren't looking at the cash brought into the business as much as they were looking at what our profitability margin percentage was, because that's what they were reporting to Wall Street, and they didn't want our lower margin to impact their stock price. So I walked away from a $200,000 net profit deal because it didn't meet the percentage margin that our acquirer cared about, but which seemed so dumb to me, but also made sense from their perspective.
Well, Abir, I'm going to throw it to you because this is the game of growth. And so growth that matters so dramatically for investors. You want to just talk through how investors think about it from, if you're going and pitching your business, particularly you've got revenue, but you're still not profitable.
Yeah, it's a great point. I'm going to mirror what Anthony said as well, because on the one end of the spectrum where you have businesses that are a little bit more mature, a little bit more sophisticated, and they're reporting to a particular type of audience, like a board or Wall Street or whatever it is, like I'll see those sorts of decisions made as well. There's a fairly large brand that weirdly I actually run their ads for, just because I have a very long relationship with them. And I'll have that conversation with kind of like the main digital dude at the company, where it's like the targets that you have at like the corporate level for what you want your advertising to be able to hit are like just completely unreasonable targets for like what you would expect from an e-commerce division, because they have huge wholesale as well. And the problem is that because you set your targets at that like ratio level, like if we want a 10x overall investment or return on it, it's like you're just losing out on incremental money. Like if we were to spend these dollars, it would be incremental profit dollars that would come into the company. Your ratio would just come down. So it's still better for you to do it, but it looks bad on a ratio basis. So exactly like Anthony alluded to, a lot of people just make these strange decisions, especially if they're reporting to people who I guess just have a very different lens on things. So it is a little bit odd from that perspective. To come to your question, though, talking about the pre-revenue side, it's funny. I'm sure you guys have seen Silicon Valley, but there's that famous scene from it where the Tres Comas guy, Russ, I think his name was, he has that whole thing where he tells them like, don't get revenue.
No revenue. Yeah, like, revenue.
Yeah, no revenue.
Revenue's for losers.
Exactly. So back when I was in a startup, I was helping them raise money back. We raised about 60 million. And at that time, it was a similar situation. We were kind of pre-revenue. And it was funny because a lot of the conversations, even like I had these really elaborate financial models built, but the conversations were a lot more about the story than anything else. Because the thing is, kind of like you alluded to, because there was no revenue yet, everything was made up. And so the moment you have revenue, all of a sudden you have something to peg against. But before that, it's all just the story. So there were these instances where I just go to the CEO. I'm like, look, man, what valuation are you trying to pitch? And you'd be like this. I'm like, all right, I can just update the assumptions. Cool. And
exactly.
there's your valuation.
Backwards from it.
Yeah, because it's the 1% change on an assumption this way or that way can change the entire model, especially when you're like expecting, 5-10 years down the road to be doing billions. Like a 1% change is a huge swing. So it's all within the realm of like imaginable possibility anyway. But ultimately, the investors, they want the model so that they feel like there was logic behind the decision. But like marketing, right? Like they justify it through logic. They make the decision with emotion, and it was really just more than anything storytelling.
Chris, I have one I guess insight that I want to get Abir's take on. Profitable growth without proper cash flow management can kill a business. Can you talk about that a little bit? Because that also seems counterintuitive.
Yeah, it's an interesting thing, and it's so common in e-com in particular because of the fact that like in the SaaS world, like we alluded to, a lot of times you have a big chunk of cash and you're just burning through it. So the cash burn is an intuitive concept, I think, to most people who are like not that good about thinking in depth about their finances. So it's intuitive. Like I have this much cash and slowly just going to burn down. And when it runs out, then I have to make sure I've raised more money by then. But the thing is, in the e-com world, it goes in these weird cycles. And so the problem for a lot of these founders is that the cycles are not intuitive. And there's this weird thing where it's like a very small business usually starts on cash accounting, which is not a great way to run a business, but that's how they start because it's the most intuitive. It's like cash went out, cash came in, like everything makes sense.
It's how you manage your checkbook.
Exactly. Right. And then when they get a little bit more sophisticated, they move over to accrual accounting. So, which again, for an inventory business makes way more sense because you don't have 100% margins in months that you don't buy inventory. Like everything matches your expenses to your revenue. But for some reason, when that happens, they completely forget how cash works. And so they'll be in this situation where from an accrual, like, profitability perspective, their unit economics are good. They're scaling. It all makes sense. They're able to sell at a price that is higher than what it costs them. And so there's overall theoretical profit being generated. But if they don't foresee the impending need to buy more inventory, for example, and I'm using just a simple example, that's when they just hit a wall. And so it happens very often that it's not so much the specifically running out of inventory. Like that's just one, event that can kind of rattle their foundation. The problem is that when that happens, most founders immediately just jump at like whatever the quickest and easiest debt is available. And that's usually a merchant cash advance. And that puts them on the treadmill. And that's usually what kills their business over time.
That's exactly right. I have a very direct example of this. And that is another thing with e-commerce business and other businesses. If you don't properly model when your company is bringing money in versus when it's spent, it's laying it out. Growth can kill you. A direct example of that is ad spend versus revenue. So if you're selling on Amazon, for example, the money you spend on ads comes out of your bank account today. It happens immediately. And the revenue from that ad spend comes in, let's call it worst case scenario, 60 days, likely somewhere between 45 and 60 days. So if you're growing, you're putting more money in that you're going to see eventually in 45 to 60 days. If you grow too fast, you run out of cash and you're done.
Yeah,
I think the classic example and probably one of the best entrepreneurial books of all time is Shoe Dog. If you read how Phil Knight funded, and this is pre-venture capital, it's pre all these weird debt instruments, and just how he was able to string together money to be able to try to just order the next batch of shoes. They were growing so fast. And every banker is classic in there. Every banker was like, you're growing too fast. You're growing too fast. It's like, you should slow down. You should slow down. And then from a startup perspective, like, slow down. That doesn't succeed.
What is that?
Right.
I don't get what that is.
I don't even understand it. All right. So I think that the place that's probably the next logical thing. So we talked about investors and we talked about sort of how it's weird. Let's just put a point on that, Abir. Talk just briefly about how companies are valued with future cash flow versus current flat cash flow. I just layman's terms, it is just one of those points to kind of make sure that people have some sort of understanding on.
Yeah, sure. So I guess to put it in the simplest way, generally speaking, the reason a person would buy something is because they think the return on that purchase is going to drive more value for them than their next best option. So when it comes to businesses, in theory, the reason that people will buy a business is because either A, they feel like they can sell it for more later down the road, or because holding it will generate cash flow that's a good ROI. So it's a worthwhile decision. So oftentimes, I say most commonly, the kind of three approaches that people really take with these sorts of valuations is that you either take a multiple on revenue, or you take a multiple on EBITDA or profit or cash being generated, or you build out one of those fancy discounted cash flow models that's multiple tabs, where you're just kind of imagining what the future is, which is oftentimes what the pre-revenue types have to do because there is no revenue or EBITDA to be able to use for a multiple.
Yeah. So I think it's really such an important point, because when they say, hey, revenue, don't start making money. It's because you're still selling this dream of future cash flow versus as soon as you start making money, that's what you're going to be valued off of.
I just realized we need a graphic. I'm going to create a graphic, Chris, for the show. When it's like a definition time. This is something that a lot of founders hear. EBITDA, you said it. What is that? Can you define that for those of us who don't know?
Yeah, great point. So the boring answer is that's earnings before income taxes, interest, taxes, and depreciation and amortization. The more intuitive way of thinking about it is that it is a rough proxy for how much cash is being generated from the business through its operation. So you're excluding a few things like the interest side, which is a function of how you were funded, because that'll skew depending if you raised a lot of equity versus a lot of debt. So saying, okay, let's exclude how I was funded. You want to exclude the investments in capital. So like if you had to build a factory or whatever, so you exclude the amortization, depreciation, all those elements. And so it's like, just what's operating this business? How much cash is it generating? And it's not going to match cash perfectly because of things like inventory, AP, whatever, but it's a pretty close metric. It is not a GAAP metric, so it's not like recognizing the accounting records, but it is something a lot of people use commonly, and it's functional enough as long as you understand where it can be misleading. It can give you a pretty good idea of whether a business is doing well or not.
I think it's a great point, because that's what I would just say top line, right? Like, what is the company bringing in and generating? And I think it gets to my next question, Abir, which is, as a founder, this is not there's this world of finance and there's this world of accounting. And sometimes these concepts get complicated when you get into GAAP. It's about how you recognize revenue, and there's some weird stuff. But really, the fundamentals of business should be simple. And so as a founder, as a CEO, what are the things I should care about most? Clearly, cash is the number one thing. Anthony, we say it all the time. Cash we say cash is king. That's not just a saying, right? other than that, Abir, what is those other components that I should be paying attention to?
So a big chunk of it, I think, would be split between financial metrics, and then I guess oftentimes what are non-financial, like leading indicators. So it'll be obviously related to your goals. If you're trying to build a business that's relatively sustainable, just kind of cruising along, growing at a slow rate, and you just want to be able to be healthy, then you're going to focus more, obviously, on the cash flow that it's spitting out, the profitability and stuff, making sure that you're able to kind of cover your churn, so you're not like slowly degrading revenue over time. Versus a business that's like really trying to target that explosive growth, then again, if they're kind of in that SaaS world where either they're avoiding revenue, then you're not necessarily going to focus on that. But depending on if you're, B2C or B2B, you might focus on kind of the amount of accounts that you're closing, the amount of users, daily active users, stuff like that. So it's a little bit of a different angle. But the point is that broadly speaking, if you're thinking about your cash, your profits, and your ability to grow, so top line, you just pick the metrics that are most indicative of how the health of each of those items are, depending on whether you need leading indicators or lagging indicators or whatever, depending on the business. So very different for a like a new social network app versus a concrete company, but the point is that you just want indicators around each of those.
Anthony, what are when you on Tuesdays, use the days that I look at financials, right? So Tuesdays and Wednesdays, I try to do all the admin stuff in the business. When on a Tuesday or Wednesday, when that day is, what are the metrics that you look at?
I'm sleeping in. I don't.
I don't look at financials.
I choose the ostrich method of looking at financials.
That's how I invest. I don't pay attention to the stock market because that shit's scary.
If I don't look at it, it's not bad.
Right.
No, I think it needs to be part of the routine, just like you said. So you need to understand it, and you cannot delegate reviewing the financials at least monthly. You've got to review the financials with your accountant, your bookkeeper, whatever, and line item by line item. You'd be surprised if you're going through stuff that you're like, wait, this doesn't make sense. Either it's miscategorized or something went off the rails, and you discover it after the fact. But it's better to do that than not even know that it's happening because of next month. So that monthly review at the minimum is critical.
I want to spin off of this for a second, which is all of us that have been doing this is, now I'm an operator, not necessarily a founder anymore. And so I really want to run a well-disciplined business. This is another question like EBITDA. Yeah, I don't so I want to run a good business. What does that mean, Abir? Like, so financially, if you're describing to somebody like, hey, this is a very well-run business financially, what does that look like?
I think it is having a very clear understanding of what your current circumstances, a very clear path for what you will need to follow to be able to achieve whatever goals you have, and being able to monitor if you're on top of that. I think that's really just the core of what finance is supposed to do. It's not to sound like a cheese ball, but it's just clarity, right? So it's you may have like a very rough idea of like, I think we're doing all right, and I want to become like, a $50 million company, and I want to sell for, 100 million or whatever it is. But you don't like, how am I going to get there? Well, I just need to grow a lot. I just need more revenue. It's if you're talking those like extremely vague terms without like a clear path on how to get to it, so then essentially the individual lacks clarity. But if you actually know exactly how much you're investing each month, what the ROI on those investments were, how you're tracking against that plan, and how after X amount of time, if you do stick to the plan, you will get to the outcome you want. And each month that passes, you're able to identify like, okay, I was expecting this to happen, but this is what actually happened. What can I adjust? You just have very, very robust clarity on what's happening and what your strategy or your plans are. And to me, that's all that finance really needs to do. I mean, who cares what box each number was put into? Like, I'll be honest, like, I don't give a shit about accounting either. Like, to me, it's all fundamentally only there to help me make better decisions. If it doesn't do that, might as well not bother.
And just a point of clarification, and again, probably most people understand this, but just to be very clear, accounting is backwards looking, finance is forwards looking. Finance is about projections into the future and looking at trying to figure that out. Accounting is, this has already happened. I just want to make
brand new information.
He's such a good CEO. That's such a well-run business. No, I think that the point there, Abir, and this is where I wanted to try to get to, is that a business is there's a way you can look at it. It's like it's a machine, right? And there's money that has to come into this machine, and that's the gas of the machine. And then out should come more profit and value and all those things for customers, et cetera. Every machine is going to be a little bit different. And so every CEO needs to understand how that machine operates, I think. Is that a fair way to say it?
Yeah, it's a wonderful analogy. It's basically, I mean, it's a box, and money goes in and more money comes out. And so to a certain extent, like you said, if you understand the way the engine of this machine is built for one company versus the next, you know which pieces to be paying attention to, how much to expect on the other side, and how to make sure you're keeping it on course.
I want to, first of all, that Anthony, do you remember years ago when they first started doing those cartoon videos, is that there was a picture of a guy pitching a box that printed money to VCs, and they're like, look, it literally prints money, and they're like, I don't know, is it scalable? It's like, the box literally prints money. All right,
so that I don't remember
it was it was commentary on our VC friends, which, you know, as I'm sitting here in California about to go talk to investors, like that's it's I love you all VCs. Hope you take my meetings today. Let's start to put a point on this. So we've talked about this idea of growth and how we should be cautious with the pace of growth. If we're raising growth capital, which is classically venture capital, that's designed to help bridge that gap. And I think that this last kind of part of the conversation is really critical, which is, for the most part, finance is about connecting what is a reasonable goal with how to get there financially. Is that kind of a good way to say it, Abir?
Yeah, it's making sure that kind of all the implications of every decision you make, you're able to see what sort of reverberations it has across the business, and making sure that like every one of those dollars that's deployed to do work in your company is giving you the best possible ROI, such that you shouldn't redeploy it in like a different avenue.
I want to ask both of you all this question, and it's just the practical advice. So I come to you and say, hey, I'm running this business. What is the best things that I can do? And so for me, even though the cash is always the most important thing, I am maniacal on costs. I want to know where every dollar is spent. So just like, what's that one piece of advice that you give founders around just understanding the financial component of their business?
In my opinion, it's about having a good routine that's robust to monitor that things are going the way that you expect. I think where things go off the rails is either they're not paying attention to the numbers, or the data they're looking at is misleading. But more often than not, it's just that they're really not paying close attention to things. But if you have the right KPIs and you keep an eye on it, then at the very least you have a sense of whether or not things are on track or not. And even if it is like reactive instead of proactive, that's better than no active.
Anthony, what do you think?
Yeah, I like that maniacal on every penny spent. I try to do that, but it's maniacal on COGS. And I have a story, like a long time ago, before I was an entrepreneur, I was a restaurant manager. I actually managed an Applebee's. Don't hold that against me. And
oh my God, how do I not know this about you?
Yeah,
Anthony?
I managed it. It's like it was when I was like in my early 20s.
Why am I not singing fancy like Applebee's, Anthony? Every time I see you. Oh.
But there's something that one of a GM that I worked for said that has always stuck with me, and he was known for running the best food cost. Food cost is just basically COGS of a restaurant, and I asked, and the one thing that I noticed when working with him is that the inventory shelves were almost always bare. He never had surplus inventory just in case. And I asked him why. I said, why do you do that? And he said, you know what? When we're about to run out of coffee grounds, the servers will measure the coffee perfectly before they dump it in. They won't scoop and do a heaping. They'll measure it perfectly because they're just about to run out. That behavior is how one of the things I'm able to leverage when running food costs. That worrying about a half a teaspoon of coffee grounds is what I call a maniacal focus on cost of goods.
I like it. There's one other piece here that we haven't touched on as I'm looking at the speed round. I just want to bring it up before we go into the speed round, which is what you were talking about, Anthony, about the ad spend going out and then revenue coming in. That's your accounts receivable cycle of Abir. That is a very, very challenging thing, particularly for services companies. Sometimes if you're invoicing customers, do you want to just talk about how you think about that? What advice you give founders about trying to manage that? Because that's a very scary time.
Yeah, you're absolutely right. I mean, fundamentally, like that's and it'll always look a little bit different on the industry, but it's your cash conversion cycle. So how long does it take for you the cash that you deploy from an expense perspective to turn that into revenue? So in an e-com brand that is, for example, say only selling online, it's a little less of a concern on the collection side because typically, a Shopify will pay them
put
the
your
next
credit
day
card
type
in,
of thing.
right.
Yeah, exactly. It's pretty fast. What often happens for businesses is that when they kind of hit that unlock, we're like, oh, we finally got into Target or we got into wholesale or whatever. It's a lot more money. And again, coming back to the point from earlier, it's a much higher amount of profit. But the problem is their business was not built to be able to have to wait 60 days or whatever to get cash back from your customer. You're used to getting it tomorrow. So a lot of times that creates a lot of wonkiness. And even in service businesses, to be honest, it happens a lot where, I mean, candidly, this was something I think in our first year, me and my co-founders, we had a lot of fights about back when we were still figuring out how to run a business. But in the early days, when it was just me and like a couple of co-founders, we would just do work for clients and we would bill them later and then they would pay later and like whatever. We would just not pay ourselves or whatever if we didn't have to because it's us. We were just doing our thing. When we started hiring employees and we had to start paying them every 2 weeks, then I remember just getting very angry at them. So I'm like, I don't know why you guys keep billing later and like be like, oh, yeah, let's just accumulate all the work and then we'll put all our hours together or whatever, and then we'll send an invoice and then they'll pay us. I'm like, but we had to pay the employees weeks ago. Like we're just financing their businesses at this point. So fortunately, like again, it's weird that accountants wouldn't have gotten that intuitively, but I think a lot of times just not being able to pay attention to that because sometimes it can be counterintuitive. That's where a lot of those cash related like pitfalls can appear.
I mean, it's such a dangerous thing. So I'm going to ask a couple of very sort of controversial questions. What you were talking about earlier is financing your accounts receivable, called factoring. I think that's so factoring is a incredibly dangerous area, I think, for some companies. First of all, define factoring and then explain when it's a good idea for us.
Yeah, in basic terms, you are taking a promise of future cash from, say, a reliable entity to say, I made a sale to Target, they're going to pay me in 45 days or whatever. So I know that I'm going to collect 100K from Target in 45 days. I can go to another entity and say, basically, hey, if you pay me upfront 97% of this invoice, we'll call it square. Target will pay you 100% in 45 days. I get the money that I need right now. So it's just a different form of financing where you're letting them take kind of just a little bit off the top so that they're able to get you that cash up front. And ultimately, it can be dangerous just like any type of financing if you don't fully understand the implications of the fees, the cash cycles, or have an idea of why you're even doing it. I think that's where people fall into the most traps, where they will get financing or take out a loan because they need cash without a specific expectation of how that cash will be paid back. But ultimately, it's just one of the other elements in your toolkit. So whether that be inventory financing, AR financing, aka factoring, merchant cash advances, regular credit lines, anything is workable. It's just about understanding what options you have and trying to make an intelligent decision about low fees and not having those other additional complications that come with debt.
Factoring is a train you can never get off.
Yeah, it's tough. I mean, you're going to have some sort
It's a one-time bump. It's a one-time bump, and now you're stuck.
If you have built your cash cycle in a way where it wouldn't work without it, then you're absolutely right. You're just stuck on that treadmill then.
Yep.
Yeah. This is a much more practical question for the vast majority of founders. When is credit cards, when is that a good idea? With the full acknowledgement, everybody make sure you hear me. If you're a startup and it says your business name on the credit card, that does not matter. It's still you and your credit, and you're still required to pay it back. Just making sure we all understand that.
True.
But when is credit cards a good idea?
I think as long as a person can be intelligent about their usage of it and avoid the paying interest on it, I think credit cards is a much more convenient way to be able to not only handle a lot of the expenses, build up the credit over time, also get a lot of points that you can use for travel, which is great. I don't have any
flew out here on
philosophical
United
problem.
points. It's great.
Hey, that's what I'm saying, right? I personally love using credit cards as long as you can be intelligent about not incurring the interest, because it's obviously pretty egregious.
Yeah, Anthony, do you support credit cards, or are you doing everything in cash?
My last business, essentially we got into the debt trap, and it's what killed it. So I am very opposed to debt unless there's a very, very critical short-term need for it that you can see your way out of having to pay it or to paying it off. So I'm anti-credit card if you're not planning on paying it off every month. Abir, I bet you're saying pay it off every month, earn the points at the very least.
That's exactly it.
And that is a very low cost factor that doesn't cost you anything. It costs the merchant the money, not you, to factor it.
Yeah, you can get
it's a very small amount, right? Yeah.
No, exactly. You can get the value from using the credit card. You get the protections of being able to, do chargebacks if that is actually necessary. So there's a lot of value, but 100%, like you said, I'm assuming you're paying it off every month. If not, totally different conversation.
It's just one of those things. And again, even though for people that are not in this world, but like if you're running a services company, the fact that you get to push out 14, 21 days sometimes on expenses, on just things like paying your, Microsoft or Google accounts, things like that, that does help. It does help get, you just get an opportunity for that accounts receivable to actually hit during that time. Last sort of question around this accounts receivable piece, and then we'll get to the speed round. This has been a really good conversation, very informative, but how do you think about accounts receivable? So again, e-commerce, I know that the money's coming in pretty quickly. Mm-hmm. People beat up startups. And I think, Anthony, this is your point, is that people beat up startups on when they pay them. I classically, my biggest deal ever, I got a deal with Molson Coors. I walked in and they said, hey, we're net 90 payments. And I was like, well, we're a little bit startup. Can you speed that up? And they went, no, that's not what we do. Like, we don't speed up payments. We're net 90. That's what we do.
They're net 90, but pay net 120.
Yeah. I mean, it's this classic thing. And I understand. And so maybe even just start with this idea of, why do big companies slow roll payments? And particularly, why do they slow roll payments to startups?
So I would say
that's how they manage cash flow.
Yeah, that's the problem. I've been in that situation too, where like I've been the victim of one of those large companies. I'll say there's two sides to it. One is that it's kind of like when the culture is just built that way, it's how you compensate for everybody else doing the same thing. So if my vendor over there is expecting me to pay them in a certain amount of time, then I just compensate on the other side for my vendors and create the same extension. So it sort of nets out on like the full basis for all the big companies. But it's part of it is just kind of that culture. If everybody paid each other on time, then there would be no need for that. But the other aspect of it is that a lot of times what will happen is that the finance department of a larger company will not see the vendors or the relationships as like, I mean, to put it simply, they don't see them as like actual humans who are running businesses who have like mouths to feed. So from their very cold, almost surgical perspective, it's just like, oh yeah, if I am able to change this number from a 30 to a 90, our cash balance goes up, our cash conversion cycle improves, so we get a better working capital ratio. So like they just kind of see the math of it. And they're technically correct, but the thing is that I've been in that situation where I had to delay payments, and I wasn't happy about it. But like they don't realize that the person that they're actually paying is a person that is struggling because of it. And a lot of times those conversations are happening either with, like, say, the startup or the person they're talking to there contact the company, who has then like the person in the finance department. And it's just that disassociation between like the human behind the company and like what the numbers look like when you play these little games. I think that leads a lot to it.
You can't you can't lean on big customers to get you paid early either, but you can lean on small customers. You can lean on smaller customers. I once called a guy's mom to get him to pay his bill. True story.
Well, I mean, my mom still appreciates you. I think that the point, to put a point on that, is that what you were just discussing is a lot of the metrics that publicly traded companies try to report to Wall Street. And so understanding that by slowing down, they can artificially make their numbers look just a touch better. And so that's going to be their game plan. And you just have to know that. And it's one of those weird things where, Anthony, when I was at Clever Funnel, we worked with startups, which was awesome, except for startups are poor. And so they paid on time, but they just didn't pay as much. Big companies pay more. They just pay more slowly. One more thing to consider. All right, Abir, are you ready for the speed round? I'm going to ask a series of questions. Answer the first thing pops in your mind. Extending payables to 60 days saves cash, but feels wrong. Is that ethical?
I think as long as you are explaining it to the other company and they are aware of what's happening and agree to it, it's arguably not unethical. But yeah, it does extend cash.
Oh, this one's a great one. Pay yourself or extend runway. Does founders' salaries kill the company?
I see it a lot more often with people who are not first-time founders, because of the fact that they've oftentimes gotten accustomed to a bit of a lifestyle, especially if they had a successful business in the past. But I think first-time founders can be a bit more disciplined. Ultimately, it comes down to you're trying to get an ROI from the business that you're investing in. I think that's the thing that should come first.
Customer wants net 90 on $1 million deal. What's your move?
I guess it depends on how used to getting $1 million deals I am. I think if you can structure you don't have economic dependence. It's not going to be like 80% of your revenue. You're able to kind of structure the way that you're going to incur your costs to compensate for it, and you're able to address or at least become comfortable with the risk that they might take longer or not pay entirely. It's all part of business. It's just risk risk assessment.
This is my favorite question. Accountant reports profit. Bank shows crisis. Fire the accountant or fix the process?
I would say it's the founder's fault for not asking the right questions. I think it's bad that an accountant is not being proactive and highlighting the things that are obviously problems, because they see that the cash balance is not there. But really, ultimately, the founder should have, in any circumstance, philosophically, nobody to blame but themselves.
Deep dive resources, The Interpretation of Financial Statements by Benjamin Graham, How to Read a Financial Report by John Tracy. I really, really like Shoe Dog by Phil Knight. Anybody that wants to understand bootstrap-led growth, particularly for a physical product, he described it incredibly well in the book. But what we're going to do, Abir, is we're just going to connect with you, and we're going to ask you all our questions. Where can we connect?
Sure, and I appreciate that. On social media, ABIR, Abir will probably bring me up. It's not a very common name, but it's usually Abir CFO or Abir CPA, depending on the channel. So LinkedIn, TikTok, Instagram, Twitter, all over the place.
Awesome. Really good and informative conversation today. Abir, thanks so much for the time. Anthony, get us out of here.
Yeah, thanks everybody for tuning in. Please be sure to visit us at howtofounder.com, where you can connect with us on LinkedIn and subscribe to our YouTube and Apple Podcasts and Spotify channels. Please hit that like button. Please hit that subscribe button. It's free to subscribe. It costs you nothing. It also costs you nothing to leave Chris a review. So leave us a great review on Spotify. Because we are here because you are the pioneer of economic prosperity. And we're just grateful for being there along the way with you guys. Thanks, everybody. Thanks, Abir. Thanks, Chris. Bye.